Let's start with the news that just broke in the last couple of hours. The Treasury Secretary, Steve Mnuchin, declining to extend several Fed emergency lending programs. Were you surprised? What's your reaction?
Well, I was a bit surprised, and I have to say that right after that announcement, the Federal Reserve Board came out with a statement expressing their interest in extending them to keep them available. And that's pretty much where I am. I think given sort of where the economy is, and there's so much uncertainty that's still out there, it's prudent to keep those things open so that when people, if they do have stress, can draw upon it.
Yeah, and Raphael, this comes at a time when there's already so much uncertainty and a bit of angst, I would say, over, wow, will the federal government be able to pass via the Congress another stimulus package? And if they can, when is it going to happen? It keeps getting pushed out further and further into the future. So it seems to an extent, if you're trying to boost confidence, if you're trying to reassure investors and consumers and businesses, the timing is not the best.
Well, what we've seen through much of this crisis has been that uncertainty has been the thing that's kept people from really engaging in the economy. You know, I go around and I talk to business leaders, and they basically tell me, I don't know what it's going to be like 3 months or 6 months from now. At the beginning of the crisis, they thought we'd be through this by September. And now it looks like we're going to be well into 2021 before there's some sort of equilibrium that we achieve where people can understand how they can do commerce and do all that sort of stuff. And this uncertainty that's looming over us, I think, is just a continuous drag. And so my hope is that as we move forward, we can resolve it, and resolve it in ways that give people confidence that they can invest if they're businesses, they can hire people, or if you're a family, that you can go out and buy the things and make the investments in yourself that make sense.
Specifically, looking at the programs that look like they are definitely going to be ended, the municipal bond facility, the corporate bond facility, the Main Street lending facility, as someone who's been working with these, seeing how they work, seeing the impact in your district, what does that mean? Is that a real loss? What is the potential outcome of that might be a negative unintended consequence?
Well, I think there are two aspects to this. You know, first, the tools and their presence in and of themselves have been helpful. You talked about the corporate facility. That is one that we started to see benefits in smoothing and functioning in corporate markets, corporate bond markets, even when people were not drawing down on those facilities. And so the presence gave people some confidence and some security that there was a backstop, and that's important. I think the other issue, and the thing that I'm going to pay a lot of attention to moving forward now, is to what extent have we not seen the drawdown on some of these facilities, but that may be coming in the future. And that really has to do with how this recovery evolves and where risks and weakness starts to emerge as we move further along into this. You know, you noted that a lot of the federal relief that's been initially offered is starting to expire. That's going to leave a bunch of people potentially at risk. And we're going to try to figure out as well as possible what those risks look like and how, if they come to full fruition, they will flow through the economy.
Now, you very recently said, other Fed officials have said, that the door is open to using all the tools, including more bond purchases. With some of these key programs in jeopardy, and maybe a question mark over the other ones, and government stimulus via more unemployment checks, more checks to small businesses, et cetera. With all that possibly not happening, at least for a while, is there more pressure now on the Fed to say, well, here's the tools we've got left, we better use them, particularly when it comes to buying more bonds?
So I don't know if I'd say there's more pressure. I think the pressure on our institution to make sure we're doing all that we can to help support this economy has been there pretty much from the very beginning. And it was really a motivation for us in our first bold and muscular actions to get these facilities in place, to start buying the assets, and to move our interest rate to effectively zero. So we've put the pressure on ourselves. We are committed to doing all that we can. And I think we still have some powerful tools. That said, and I've said this, and my colleagues have said this as well, the best and most appropriate way to move forward is for this to be an all-hands-on-deck situation. Right. So monetary policy works, fiscal policy works, and whatever other facilities we can get out there, they all, if they're pointing in the same direction, we can be much better off in terms of what a recovery looks like.
I want to ask you one more very specific question. about this issue of more bond purchases. What does Raphael Bostic have to see in the economy? What are you watching to say, yep, you know, maybe I'm not a big fan, or we don't know how it's going to work or how much it's going to do, but time to buy bonds. I vote yes.
I think there are two things for me right now. One is I'm paying a lot of attention to what's happening with jobs, and in particular the jobs that were lost. When that first happened, most of those jobs were listed as temporary job losses. In recent weeks, we've started to see a lot of those temporary jobs convert over into permanent job loss. To the extent that happens more, that says to me there's a lot of weakness. Then another thing I'm looking at is, you know, I've talked to a lot of my bankers, and they have a good eye on how those relief checks have come into families and how they're going out. And to the extent I start to see that there are a lot of families that have burned through their savings and don't really have options in terms of how they're going to stay in their home or buy food or whatever, that's going to be another sign that we are at a tipping point that will require even more energetic engagement on our part.
And of course, all this is happening as the virus resurges in the United States and other countries around the world. International Monetary Fund, in a report and from its own chief on Bloomberg Television earlier, concerned that this could derail the global recovery. What about the U.S. recovery, Raphael? You've been saying that, oh boy, by the second half of next year, virus kicks in, we could have a very robust recovery. But what about right now? Is there a risk this goes off the track?
Well, there's certainly a risk. You know, I've said all along, at its heart, what we have is a public health problem first that has morphed into an economic problem. And if we don't deal with the public health aspect, it's very hard to imagine how the economics are going to come back very robustly. So we've got to get that under control. You know, the news on the vaccine and the progress that's been made there is very promising. But, you know, a vaccine is not going to get through the whole economy and through our population before probably the middle of next year. And so we've got a short-run issue that we've got to take care of. And I'm hopeful, you know, every event that I speak at, I say we've got to follow the advice of public health professionals. Wear a mask, wash your hands, mind your distance. And if we do those things, what we've learned is that we can manage, but we've got to be responsible on this. And if we are not responsible, that pushes back what recovery is going to look like when we get back to how we were pre-COVID. So, you know, I'm going to continue to yell from every mountaintop I can, you know, get your masks out. You don't have to wear them all the time, but there are times when it is important that you do that just so we can try to get the spread of this virus under control.
Do you agree with some of your Fed colleagues who think that there's a risk we could see negative growth fourth quarter, first quarter next year?
There's a risk. That's not in my model right now, but it's something that I definitely have to monitor. You know, we expected there to be some slowdown off of the second and third quarters, which came in much stronger than I expected in the fourth. And I was expecting, and my team is, that the beginning of 2021 is going to continue to show that positive growth and continually pick up as we get further and further away from the initial month. So there's risk, but that's not in my model right now.
I want to ask you about the housing market. We had amazing existing home sales numbers today. I mean, I'm a journalist, I shouldn't say amazing. I should say they were very strong, President Bostic. But, you know, the number, about 6.5 million units annualized. You know, we're looking at the kind of numbers we saw back at in the 2000s, when the annual rate got up to, over 7 million annualized in 2005, I believe it was. Of course, then we had a bit of a bubble that burst and all that. Are you a bit wondering, concerned perhaps, that all this stimulus from the Fed, low rates, bond purchases, have helped fuel something that begins to look like a bubble?
So I'm not seeing signs of a bubble right now. And what I would say is, you know, people are being prudent in their money management. If they have resources, if they have a job, it gives them an opportunity to do their refinances. And so, you know, when you think about the recovery, it's really a tale of two recoveries. One, where people have who are at risk found out that their jobs were going to still be there, that they were able to work from home, they were able to do those things. They still have income, and they're able to sort of reposition themselves in a firmer way. And then on the other side, you have a bunch of families and businesses who just don't have that same sort of luxury, and they have risks as well. And you know, one of the challenges that we have as policymakers is that we've got, particularly as the Federal Reserve, you know, we've got tools that we have to apply to the entire economy. But what I am most concerned about at this point is that we don't forget about that segment of the economy that is still in pain, that is still precarious, and is still at risk. And so until we get that under control, I think our policies are well positioned, and we have to continue to provide that support for families.
Inquiring minds want to know, sir, you just assumed a new role with the Atlantic Chamber of Commerce. You're the chairman-elect for 2022. So are you expecting that you're going to be staying in Atlanta? There's been a lot of talk. You might move to Washington and take some kind of new post. You seem to be considered for many in a new administration, assuming Joe Biden is the next president, which is, of course, what we think he is.
Well, I've seen my name on a lot of lists. You called it out. What I would say is I have not spoken to anyone with the transition team right now. And so I've got to go about doing my job. And there's still so much to do that I'm just going to keep my head down and do those sorts of things. And we'll see sort of what the future brings.